Tom Lee, one of the most respected investors on Wall Street and co-founder of Fundstrat Capital, just appeared on CNBC to break down Trump's tariff news, the latest market trends, the state of the economy, and how policy uncertainty is shaping the stock market right now, and according to him, earnings are likely to hold up better than expectations. So here's what we're going to do. First, I'm going to play you the clip of Tom Lee's appearance so you can hear exactly what he had to say. Then, I'll give you my reaction and break down the key points he made. And after that, I'll dive into the one important stock you should be looking at right now, especially with Trump's Liberation Day tariffs in play now. If you're serious about investing, this is a video you do not want to miss, so make sure you watch until the end. And while you're here, do me a favor. Hit that like button. Let's get this video to 1,000 likes, share it with someone who needs to see it, and drop your thoughts in the comments below. And of course, don't forget to subscribe, so you never miss an important financial update. Alright, let's get into it. Here's what Tom Lee had to say.
Tom, I know you agree with a large part of what the professor said. That's what you're trying to do and impart on our investing audience. Those are the headlines from the notes that you continue to put out. Tough now, better later. Invest for the longer term this year.
That's right. We don't want investors to be panicking now or rage selling. We've had a very painful drawdown, and I know we're facing this huge uncertainty that may not end tomorrow, might last months. But like the other declines in stocks, like the one last year or the ones in 2022, the ones who could endure that short-term pain and took advantage of those declines are going to have good opportunities.
Dan, what if things are different, though, this time? That these tariffs are going to be a favored measure by this president, whether they're permanent, temporary, months, years, no one really knows. They're not going to be a day. You know that.
Yeah, listen, across the street, every big bank, every medium-sized bank, I'm sure Fundstrat have hosted calls with their clients to discuss what they expect for tariff. And I've been on a couple of those calls, and there's universal, complete uncertainty as to what's going to be announced in even 45 minutes time, let alone 45 days time. So I think it's fair to Tom's point and to the professor's point for everybody to have a little bit of fog in their investing outlook right now. However, I want to take a step back here and just note to the professor's point that stocks are long-lived assets. Risk assets are long-lived assets. And unless you think a recession is forthcoming and a meaningful decline in earnings is forthcoming, then probably your best bet is to ride this out. And to your point about EPS, 280 right now for the next 4 quarters is basically unchanged over the last couple of weeks. Now, you could say that's the ignorance of the market, thinking that this isn't going to matter, and someone thinks it does. But it also could be telling you that maybe the tariff headlines, which populate all the newspapers, aren't quite as bad as the reality on the ground.
What about that, Tom? At the end of the day, this entire conversation comes down to what earnings are going to be. And then we have to decide what we're willing to pay for the earnings in stock prices. Do you have any level of confidence now that you can see through whatever fog exists?
Well, I think people are making what I would call like linear adjustments to earnings because they're making a tariff assumption, not assuming that there's companies that can find ways to either get efficiency or they're going to get a currency benefit. I think earnings are going to change a lot less than people expect. And the easiest way to see that is the bond market is a very good economist. High yield spreads have not widened dramatically, even this week as stocks took it on the gut. And if you look at one year inflation break even, so the estimated inflation from 1 year from now, 1 year ahead, that's actually fallen 30 basis points. So the bond market is not expecting more inflation. I actually think earnings are going to hold up a lot better than people expect.
Don't you think, though, that to some level it's almost undeniable that margins are going to take a hit, that the companies, by and large, don't have the level of pricing power that they once did because they know that consumers are sick and tired of inflation and they're tired of seeing prices go up. There's no appetite to raise prices, at least initially. You're going to eat it. Yeah. And you're going to see a lower margin, which is the story.
Yeah, and I don't want to get a little dark here, but we know companies were hoarding labor for the last few years, and there was a stigma for downsizing or retirements. But we know AI is actually producing enough PhD level type workers that you could see companies re-engineer. I think labor costs will be one of the solves for why earnings might surprise in the next year.
And let me add, while clearly tariffs are not a boost to margins, there's little doubt about that, there are there's a shared pain here amongst companies, and it's not so easy. I was watching a news report on one of the political news shows before. They were interviewing someone who said, well, the car is coming in, it was 100,000, now it's going to be 125,000. And that's not how it works at all. Obviously, it's on value added. It's a little more complicated than that. And in the case of margins, Walmart, let's say, is not going to eat all of this. Some of the suppliers are going to eat some of this. Consumers are going to eat some of it. Walmart itself is going to eat some of it. So ascertaining the exact hit to margins across sectors, particularly consumer discretionary, is much more complicated than simply saying.
Well, you're also addressing the so-called the power position, the bully position of the companies like Walmart, who can have that leverage over their suppliers. Not all companies certainly have that.
No, that's fair.
And to that degree.
And maybe I might want to add one more thing. There's going to be a lot of onshoring in the U.S., maybe as much as $6 trillion of capital assets. That's additive to S&P earnings.
Let's break down exactly what he's saying and why it matters for investors right now. Tom Lee's main argument is clear. Don't panic and don't make impulsive decisions based on the short-term market pain we're seeing. He acknowledges that the recent drawdown in stocks has been tough, but he reminds us that this isn't the first time we've seen uncertainty like this. We've had similar downturns in 2022 and even last year, yet markets eventually recovered. According to Tom, those who manage to endure the pain and take advantage of the declines have historically found great opportunities on the other side. So, his core message: stay invested for the long term. Now, one of the big concerns raised in the interview is whether this time is different, specifically with tariffs and the uncertainty around them. The question is whether tariffs are going to be a temporary political tool or something that sticks around for years. And honestly, nobody knows for sure. As Tom points out, every major bank, including his own firm, Fundstrat, has been hosting client calls on tariffs. But even the biggest experts have no real clarity on what's going to happen in the next few days, let alone the next few months. That brings us to a key point: uncertainty in the market. Tom acknowledges that investors are feeling lost right now, but he also reminds us that stocks are long-term assets. He makes the case that unless we're heading for a deep recession, one that truly slashes corporate earnings, then the best move is to ride out the storm. And here's something interesting. Despite all the fear in the news about tariffs, corporate earnings projections haven't really changed. Analysts are still projecting the S&P 500's earnings per share, EPS, at around $280 for the next 4 quarters, which suggests that Wall Street, at least for now, doesn't see tariffs as a major game changer. Now let's talk about how Tom Lee views corporate earnings in this environment. This part is crucial because at the end of the day, stock prices are driven by earnings, and the question is whether companies can maintain profitability despite rising costs and economic uncertainty. Tom takes an optimistic stance here. He argues that a lot of investors are making linear adjustments to earnings, meaning they're assuming that tariffs will directly cut into profits without considering other factors. But he believes that many companies will adapt, whether that's through operational efficiencies, shifting supply chains, or even benefiting from currency fluctuations. In his view, earnings won't take as big of a hit as people fear. And he backs this up with a strong point: the bond market. Tom says that if the stock market's fears about tariffs and inflation were truly justified, we'd see clear warning signs in the bond market, like widening high-yield spreads, which indicate rising risk or inflation expectations jumping significantly. But that's not happening. In fact, one-year inflation expectations have actually dropped by 30 basis points, which tells us that the bond market isn't pricing in a surge in inflation. This, according to Tom, is a strong signal that corporate earnings are likely to hold up better than many expect. Now, the next big concern raised in the interview is profit margins. With inflation already putting pressure on consumers, companies don't have as much pricing power as they once did. People are fed up with high prices, and businesses can't just keep passing higher costs onto consumers like they did before. That means many companies could see their profit margins shrink. But here's where Tom introduces a controversial take. He suggests that AI and automation could actually be a game changer for businesses. And this is where things get really interesting. Tom brings up the fact that over the last few years, many companies have been hoarding labor. They've been reluctant to lay off workers because of the tight job market and the stigma around downsizing. But now, with AI advancing rapidly, businesses may start replacing some of those jobs with AI-driven efficiencies. In other words, cutting labor costs could be a way for companies to protect their profit margins, even in the face of higher costs elsewhere. That's a bold prediction, but it's something worth watching closely. Then there's the issue of tariffs and corporate pricing strategies. Tariffs aren't great for margins, that's obvious, but Tom points out that the impact isn't straightforward. In many cases, the cost increase doesn't fall on one party. It's shared across the supply chain. Take a company like Walmart, for example. If tariffs increase the cost of imported goods, Walmart won't just eat the entire increase. Instead, it'll pass some of that cost onto its suppliers, absorb some itself, and maybe adjust its pricing for consumers. This makes it difficult to predict exactly how tariffs will impact different industries, especially in consumer discretionary sectors. And this ties into another key point. Not all companies have the same level of pricing power. A massive company like Walmart has leverage over its suppliers, meaning it can force them to absorb some of the cost increases. But smaller companies? They don't have that kind of negotiating power, which means they might feel the pain of tariffs more directly. So, what's the big takeaway from Tom Lee's perspective? First, he's cautiously optimistic about earnings and the market's ability to weather uncertainty. He believes that companies are more resilient than many investors think, and that fears about a massive earnings collapse are likely overblown. Second, he's pointing to AI and automation as a potential margin-saving tool for businesses in the coming years. If companies can reduce labor costs without sacrificing productivity, that could help offset some of the pressure from tariffs and inflation. And finally, he's using the bond market as a key signal. So far, the bond market isn't showing signs of panic, which suggests that the worst-case scenarios many investors are fearing may not actually play out. So, should investors be worried? According to Tom, not as much as the headlines might suggest. While uncertainty remains, history has shown that staying invested and thinking long-term is usually the best approach. That's the breakdown of Tom Lee's take. What do you guys think? Do you agree with him, or do you think the risks are bigger than he's letting on? Let me know in the comments. Alright, let's talk about the company you should be looking at adding to your portfolio with the Trump tariffs in play. Nucor Corporation, ticker symbol, NUE, the largest steel producer in the United States. This company operates over 25 scrap-based steel mills nationwide and manufactures everything from sheet steel to plate steel, structural steel, and bar steel. Key materials used in construction, automotive manufacturing, and major infrastructure projects. Right now, NUE stock is trading at $123.03, giving it a market valuation of $27.6 billion. It's up 2.5% year-to-date, but here's the real kicker. Trump's Liberation Day tariffs on imported steel could be a major catalyst for this stock. These tariffs, which might match or even exceed previous duties, are designed to protect domestic steel producers like Nucor from cheap foreign imports. And history tells us exactly what happens when tariffs go up. Nucor wins. We saw this play out during Trump's first term. His steel tariffs gave Nucor a major boost, and now, if similar policies return, demand for US-made steel could surge, driving up Nucor's prices and market position once again. Alright, let's break down the numbers in a way that actually makes sense. Nucor is in pretty solid financial shape. Last year they pulled in about $30.7 billion in revenue. Yeah, billion with a B. After expenses they walked away with $2.03 billion in net income, so they're definitely making money. Now if you look at earnings per share, they're sitting at $8.42 and their PE ratio is around 14.6, which means the stock isn't crazy overpriced like some other industrial stocks out there. And for those of you who love dividends, Nucor's paying out a 1.77% yield, so you're getting a little something back just for holding the stock. But here's the kicker. Nucor's stock is trading over 80% below its fair value price of $221.54. That's a massive gap, and could mean a huge upside for long-term investors. So, is NUE stock a buy before Trump's tariffs shake up the market again? Let me know what you think in the comments. If you want to take your investing to the next level, Forecaster is the ultimate tool I trust to find incredible stocks like these. Don't wait. Try it for free today. Just click the link in the description with my code Galore10 for an exclusive 10% discount. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. And hey, if you found this breakdown helpful, smash that like button, subscribe for more investing insights, and let's keep making smart money moves together. Don't forget to share the video with your friends and leave your thoughts in the comments. See you in the next one.